Probabilities exist when the facts and circumstances known to an individual would cause a reasonable and prudent individual with knowledge of said facts and circumstances to determine that an incident has occurred, is occurring, or is likely to occur. Probabilities. Welcome to PSA 1, the system, part 3, the macros. When you're looking at the macros, you're really looking at charts. Think of charts as your gauges. There are many charts to look at, just as there are many gauges to look at. Gauges that tell you what's happening inside of that vehicle. And if you know what gauges to look at, then you can get a general sense of how the vehicle is doing between maintenance and inspection. Think of that as you would these charts. So the question that we're going to answer, what are the true warning signs of a recession? What charts do you look at? There are so many of them to look at. It's so easy to get confused. Let's look and see which ones are the right ones to look at. Before we proceed, I do have to make a couple of clarifications to my previous videos. So first and foremost, before you buy any stock, any equity, any security in any company, always know, actually, before you make any investment, period, always know your exit point and your entry point before you enter. You don't want to just jump in blindly, okay? It's important to know when you're going to get out, good or bad. What is the yield curve? The yield curve has to do with the bond market, specifically treasuries. The Treasury Department issues treasuries in increments based on time. This list that's on the screen now is the current list of yields, the percentage rate of interest U.S. government will pay for debt based on that increment of time. The yield curve is where they take the 10-year Treasury minus the 2-year Treasury. As a relational example, you would think that if you borrowed money from someone for the span of 10 years, that it would cost you more interest than if you were to borrow money from someone for the span of 2 years. It just kind of makes sense. There's more volatility involved, there's more risk. It just would make sense that it would cost more for long-term debt. The yield curve is a matrix that people use to gauge the current state of the economy. If you notice, every time that things have gotten a little strange when it comes to treasuries, by strange I mean long-term debt being less expensive than short-term debt. Every time in history that we see on this chart that it has gone the opposite, that always, based on this chart, turns into a recession. Back before the 2020 incident that happened, briefly, and that was the predictor, the economic predictor of what happened in 2020. If we move it back, this is when it inverted before the 2008 GFC. You can see it inverted briefly in 2006, uninverted, and then it inverted again in 2006, and it took all the way until 2007 to uninvert. And we all know what happened shortly thereafter. Let's look at a different one. This is the dot-com bubble. If you notice, around February 2000, it inverted. It stayed inverted for pretty much the entire year. And we all know what happened after the dot-com bubble. I believe this event was called Black Friday, but as you see, December 1988, it inverted, and it stayed inverted till April of 1990. What happened after that? A recession. And of course, let's look at the recession back in the 80s. Look at the yield curve inversion chart and look at the recessions that were in the middle of them. So when we look at the long-term yield curve, meaning the 10-year versus the 2-year, we can see that every single time it inverts, it's followed by a recession. And what do we see before us today? It has been inverted longer and deeper than any other time from what I see. Since July 7th, 2022, we have been inverted. Right around the 1st of September this year, it uninverted, meaning things went back to baseline. As you can see here, the 10-year cost 3.678 and the 2-year cost 3.645, which it's close. It's pretty close to flat level, but at least it's not inverted. And when things go back uninverted, based on a bull steepener meaning the front end of the curve, the 2-year treasuries coming down faster than the 10 years, which is exactly what happened in this case, always results in a recession. We can't say for certain that it's going to happen right now, this case, but we can definitely look at the probabilities and make a reasonable determination based on what we see. To further illustrate this point, we can even zoom in a little bit to the 10-year versus the 3-month because it follows the same pattern. However, it seems to be a zoomed in view, which gives you a little bit closer relation to the timing of it. Not that we want to time the markets, but we do want to take a look and see. We are still heavily inverted when looking at the 10-year versus the 3-month. We are inverted by negative 145 basis points, which is a lot, 1.45%. But just like the 10-year, 2-year, every time it's inverted and come back to baseline, it has been followed by a recession. So when we're talking about inversion, that's what we mean. Something in the market is making this happen, and something in this market has predicted a recession every single time they've done this. The cost of a bond, if the cost of a bond is on this axis, it costs less. That means that the treasury has to pay more interest. When the yield goes down, the price comes up. And an example of this would be looking at the TLT or the TUA. TLT. Let's look at the TLT. When people needed bonds last, well, that was right around the time of the last problem that we had in the economy. Look at how high bonds went in value because everybody was seeking safety. Make sense? Will the Fed drop interest rates? Let's take a look at the chart. As you can see by the chart on the long-term view, since all the way back in the 50s, does it look like it's a good thing when the Fed funds rate drops? They dropped rates in 2020, and we know what happened. They dropped rates in 2007, and we know what happened. They dropped rates at 2000, and we know what happened. The 90s. It seems that most times they drop rates besides right here, which eventually followed not much longer after. It certainly looks like every time they drop rates, it's followed by a recession. So it doesn't look like it's a good thing. And if we zoom in, what does it look like is about to happen with us? Well, if you look at the CME watch tool, they say that there's a 72% chance probability of dropping interest rates. When you look at the 2-year treasury versus the Fed funds, it's interesting to see. It certainly looks like the Fed follows the free market of the bond market when setting interest rates. Look and see. The blue line indicates treasuries. The red line indicates federal funds rate. Notice that the treasuries go up first, then the Fed funds follow, and the treasuries go down first, and the Fed funds most certainly look like they're going to follow. Certainly seems that the Fed has an illusionary control of the price of the yields. Does the unemployment rate matter? Let's look at the chart. So when we look at the unemployment rate, we can see the direct correlation between a rise or spike in unemployment and the recessions. Where are we at now? We can clearly see that we're on a trajectory upward, and there just so happens to be an indicator that tells us exactly what that means, and that's called the Sahm Rule. The Sahm Rule indicates that when unemployment rises by 50 basis points or more within a 3-month time frame, then it triggers a recession. Let's look at current Sahm Rule indicators. According to the current Sahm Rule indicators, we are at 0.57%, 57 basis points within the last 3 months of a rise in unemployment, and that indicates that we are very likely going into a recession. This is the Sahm Rule chart, and it shows right here we broke past the baseline and we're now sitting at 0.57. Another indicator is what they call the Beveridge Curve. The Beveridge Curve has to do with the job vacancy rate versus the unemployment rate, but it's a pretty complicated chart. You'll see that it's difficult to understand. However, Jeff Snyder, again, the genius economist that he is, in this particular video that I'll put a link to in my video, he breaks down the Beveridge Curve in a way better way than I can explain it, so I'm not even going to try. He's the expert on this. Needless to say, we can determine based on the Sahm Rule, the Beveridge Curve, and the general look at the chart of the unemployment rate that it certainly appears that unemployment is on the verge of peaking and spiking. Is the national debt sustainable? Let's look at the chart. So our current national debt, according to the chart, is almost 35 trillion. And if you look at this chart, it looks like a hockey stick. Hockey stick meaning at the beginning of the hockey stick, it just goes straight up and it keeps on going up. And you would think that it could go up forever, but unfortunately it can't. I would encourage you to look at Dr. Chris Martinson's Peak Prosperity, where he describes exponential growth and the limits that it has. We cannot keep growing our money forever without facing certain consequences. And the consequences of quantitative easing, continual printing of money, growing of money, is that we're going to face some sort of an inflationary market. Now, economists talk about deflation, inflation, inflationary deflation, stagflation, all these different inflation. I'm not an economist. It's too technical for me to understand. But what I can understand is what I call inflation, which is the purchasing power of my dollar not being what it once was. And being that we know that currency is inflationary in nature, and we know that quantitative easing, where they're printing more money, deflates the currency, we know that it could be a potential problem. This video explains it in better detail than I can. And in this video, he talks about the oil exponential use, the money exponential printing, and the natural resources exponentially being used. And as a result, we're on an unsustainable path of excess. Exponential growth has to do not just with the amount, but the speeding up the time frame plus the amount of growth that is impossible to keep up with. While we're looking at that, I'd like to just talk about the oil reserves that we have in the United States of America. This is the SPR chart, which shows our reserve of oil. And look at how low it has gotten in comparison to recent years. Is this a good thing? We're using more oil than we ever have. We have less in reserves than we ever have. And we're spending more money and growing more money than we ever have. Does this seem sustainable to you? What is our general economic condition? Well, besides the fact that the yield curve just uninverted, that unemployment rate seems like it's about to spike, the Federal Reserve looks like it's going to drop interest rates very likely next week at the FOMC meeting. In addition to all of these things, the exponential growth of the debt, we have a commercial real estate crisis that's on a bubble. We have the real estate sector that has come to a complete grinding halt due to prices and interest rates. We have an energy and shipping crisis that no one seems to want to talk about, specifically with what's happening in the Red Sea. Exponential use of oil, natural resources, and population growth. Global economy is not looking very good when you look at Japan from the recent carry trade issue that's happened. Germany, China, things aren't looking good on the global front when you look at the entire economy. Not to mention the wartime environment that we're seeing in Israel, in South America, in Russia, Eastern Europe, in South America, and not to mention in our own homeland. The current civil state of the Union, I would say, is a little hot right now. It is a place that happens to do the best as far as assets in a wartime inflationary type environment. That would be commodity producers, specifically energy, which is one of the reasons why this is part of my thesis. However, if you're looking at commodity producers, you have to remember it typically dips before the recession, and we are not in the recession yet. Therefore, it certainly looks that it's going to continue to dip until it forms its bottom. Then we shall see what happens when the bull market starts. Let's recap the macros. First, the yield curve has to do with the treasuries, the debt, the cost of debt, and the inversion has to do when the cost of debt gets a little weird. When we talk about the unemployment rate, it certainly appears that it matters, and we have certain indicators that are showing us that it's on the brink of rising. It very much looks like the Fed is going to drop interest rates next week at the FOMC meeting, according to all of the indicators that would tell us such things. The national debt is on an exponential growth cycle that is absolutely unsustainable by every measure that we have. In the current conditions of the economy, well, there's a lot happening in the world right now. This concludes PSA 1, the system, Part 3, the macros, and really this concludes the economic sector of the system. If you're only curious about how the banking system works and how to make money and how to read the market, then this is as far as you need to go. The second half of the system is where we really dig a little bit deeper and find some real answers. And at the end of the second half, we're going to talk about exactly what you can do to protect yourself and your family from what we absolutely know is coming based on the probabilities that we see before us if we simply open our eyes and look at the truth that stands before us. Next up in the series is PSA 1 the System Part 4. Who is doing this? Who's behind it all? But until then, may God bless you, may God bless your family, and may God guide you to peace and prosperity.